I just swipe from this corner up and it screenshots. Another way you could screenshot is power volume up. Power volume up, it screenshots also. Okay, um so first of all, let's start with assignment. What is assignment? What do you remember about assignment? Okay, so here we go. You ready? Assignment has to do with policy ownership. Okay. So it's either going to be it's going to be either full assignment, which is in the test is going to be absolute assignment, or collateral assignment, which means partial assignment. So for example, I have a policy and let's say you want to be the owner of the policy, then I could do that. I could give you absolute assignment of it, and now you own the policy. So policy owners are able to change beneficiaries, change coverage, change. I mean, you could do a lot of things. So when you get it, you're obviously going to you're going to obviously put yourself as a beneficiary, right? Because you're the owner of the policy. You want to be the beneficiary of the policy. You could put whoever, you could put Destiny Church, you could put whoever you want, okay? But just know that you could transfer a policy ownership to somebody else through absolute assignment. Or collateral assignment is you could use a policy as a collateral to get a loan or something for whatever. It doesn't matter for whatever. So for example, let's say let's say I come to you and I say, "Hey, I need a $50,000 loan." And then you're like, "Well, let me see your credit." And your credit, let's say my credit sucks. Then you're gonna be like, what else do you have? Do you have a mortgage? No, I don't have a mortgage. So I could do a collateral. You see what I mean? And then I'm like, I don't have a mortgage. Do you have a life insurance policy? And then I say, yeah, I do. Actually, I have $500,000 in coverage. And then you say, okay, perfect. Let's use a collateral assignment and I'll lend you 50,000, but I need you to give me 50% beneficiary of your policy. You see that? That's called collateral assignment.
So with collateral assignment, isn't it too like after you pay the loan back, you can say after this agreement, you can remove you.
Everything goes back to normal. Yeah, exactly. Absolute assignment is you're transferring somebody's policy. This is for people that like same scenario, right? No, no, different scenario. So let's say I need money. I need money and I have a policy that I've been paying. I have let's say I have $500,000 in coverage on myself. And then you're like, I'll pay you, Raul, 200,000 for your policy right now, cash, boom. And then I'm like, all right, let's do it. Now, I'm going to give you absolute assignment of the policy, and you are now the owner. So now, if I die, you get 500,000, and you paid for that, right? You paid $200,000 to me, so you bought me out. You see what I mean? So that's an absolute assignment. Got it? All right, that's going to be on the test, bro. So look out for that. All right, let's keep going. Look at the verbiage here. It says absolute assignment involves transferring all rights of ownership to another person or entity. Collateral assignment involves transferring partial rights to another person or entity. Got it? Let's keep going.
Also the name too.
Yeah. Selecting charging settlement options. Cash value dividends. Free look period. Okay. You remember free look period? What do you know about free look period?
Free look period is a period where you can get your day period. If you're if you're 62 or 65,
60.
60
60.
or older, you have a 30 day.
Yeah. Good. Good job. Good job. All right. Let's keep going. Payment period, grace period. What do you know about grace period?
Grace period is is the time lapse.
So think of grace, right? What does the word grace mean? What does the word grace mean? Grace. So remember grace. Grace means that this is for people that haven't made a payment on their policy, but there's a grace period of 60 days that the policy remains active even though you're late. Even though you haven't made your payments on time. See that? So 60-day grace period means that if you die when you haven't made your payments and you die within 60 days, the company still pays. The policy is still active. That's later on. That's I'll talk about that right now. That you know what? Let's talk about it right now. It's good. So so okay.
Grace period and policy lapse are the same thing.
No,
No, they're not.
no. So grace period, there's a 60-day grace period, right? What happens after 60 days? Now, after 60 days, now it lapses. Okay. Now it lapses. That means
Wait,
the
so you
policy is not active anymore. Okay. So the policy is not active, it lapses. Okay. So what happens? What happens is that you have to after that you have to there's a word down here. You see that word?
mhm.
So after it lapses, you have to reinstate it. And to reinstate it, you have to pay the back premiums that you're late in order for you to reinstate it. Get it? All right. So now let's talk about your cash value. But what if you have cash value? If you have cash value in the policy, after the grace period, it goes to the cash value. It dips into the cash value to pay the policy to keep it active. But once the cash value runs out, so once the cash value goes down to zero, now it goes to lapse. See that? Any questions on that? So you learn you get it. The grace period, cash value is called on the cash value part is called on the test is called an automatic premium loan. So anytime you pull off from the cash value is called a loan, and it's automatic. It's automatic to pay the premiums. So you see how everything's connected. Everything is in the word. Automatically, you pull out a note to pay the premiums. Automatic premium loan. Got it? Any questions? Okay, cool. Dude, this stuff is gonna be on the test for sure. Okay, so I'm glad. Yeah. Oh, look at the reinstatement. There's a 3-year reinstatement period. 3 years.
What do you
So
mean?
so that means you could reinstate it up to 3 years. After 3 years, you just write a new policy. Okay. Incontestability. What is that? Incontestability, just think incontestability, think 2 years. Okay, so what happens here? Remember?
Okay.
All right, so I'm gonna tell you. When when somebody dies, when the policy's in force, and then you die within 2 years, then what what happens is that what happens is that the insurance company has a right to contest the policy to see if there's fraud. Like somebody committed suicide or they lied on the application. The company has to contest, which means investigate to see if there's fraud. After 2 years, it's incontestability. That means that even if you did fraud after 2 years, it will pay. If you die by suicide, it will pay. You see what I mean? So incontestability after 2 years. Yes, sir. Any questions? Exclusions. Exclusion means that it will not pay based on these things. So one easy way to remember exclusions. Here, let me delete this again. Okay, exclusions. So when it comes to exclusions, one thing to remember is the word wash. Exclusion wash. Wash. Wash is war, W for war, A for aviation, E for S is for suicide. Where's suicide? Oh, it's in the bottom. So S is for suicide and H is for hazardous sport or hazardous job. Wash. Remember, wash. Exclusions. That means that if you die this way, insurance companies are not obligated to pay.
Okay.
Exclusions. There's suicide right there. War,
Aviation,
aviation, suicide,
suicide,
hazardous sports, or hazardous occupations. It says hazardous occupations or hobbies.
skydiving. I'm remembering the pictures from the video.
Yep. Okay. We're good. Ownership, assignment. All right, you already know. So let's review. Entire contract. Entire contract includes the policy plus a copy of the application. So the entire contract is the policy itself and a copy of the application. That's the entire contract. All right, let's keep going. We're limited with time. So beneficiary, this is session, primary beneficiary, revocable. Okay, revocable or irrevocable. What do you remember about that? Give me an example of revocable or irrevocable beneficiary.
Revocable is you want to, let's say, a policy, switch over a policy holder, and you want to, revocable means you don't have to ask permission. Irrevocable, you have to ask permission of the beneficiary.
Yeah. Yeah, revocable means that you can change beneficiary. And irrevocable means you can't change beneficiary only if what?
You have permission.
Only if you have permission by that beneficiary. All right, good. Just keep going. Spendthrift clause. Okay. Spendthrift clause, that might be on the test. Spendthrift spendthrift clause is a clause that protects beneficiaries when somebody dies against people going after that money that like creditors, for example, let's say I die and I owe $10,000 in a credit card. And then I die, and the credit card company knows that my wife is going to get some money. So they now go after my wife. They can't do that because of the spendthrift clause. They can't do that. So, so this protects beneficiary money from creditors. Okay. I'm just cramming stuff here. Spendthrift clause. So policy loans means you pull out money from a cash value. Remember that? Okay. What does term insurance have cash value? No. How about whole life? Universal life? Variable universal life? Anything that has universal life has cash value, just to keep it simple, okay? There's the automatic premium loan. That's what we're talking about right now. That it'll automatically do what? What is automatic premium loan? In case when?
In the during the
After the grace
after the
period,
grace period. 60 days?
which is 60 days. Good, good, good. Let's go. Non-forfeiture options. Dang, this is so important right here, bro. This is gonna come out on the test, okay? What is a non-forfeiture option? Think of think of the word. It's in the word forfeit. What does forfeit mean? To give up. So non-forfeit means I don't want to give up, right? So you let's say you're paying 300 bucks a month on your life insurance policy, but it has to be cash value, okay? This only applies to cash value policies. Let's say you're paying 300 bucks a month on a cash value policy, but then you're like, I can't afford it anymore. I can't pay for it, but I don't want to forfeit my policy. So what are my non-forfeiture options? Get it?
Yeah.
All right, so that's the scenario. So let's talk about that. The first non-forfeiture option is just cash out. Just cash me out. The second non-forfeiture option is called extended term non-forfeiture option. Okay, so what does this mean? Let's talk about it. Extended term, extended term non-forfeiture option keeps so let's say the coverage was $300,000. It's going to keep $300,000 the same. The coverage is going to stay active. But I'm no longer making a monthly payment of 300 bucks, so they're going to use my cash value to pay for the 300,000, but it's going to end soon because it's not going to because once the cash value runs out, the policy ends. You see what I mean? But at least I'm not making monthly payments. Everything good? So Coverage stays the same, but it ends soon. That's why it says term, because it ends soon. So keep the same coverage, but it ends soon. Okay. All right. Remember that. Okay. Next, number three. Number three is reduced paid up. Reduced paid up keeps it till age 100, but it's not going to be 300,000 like here. Extended term was 300,000, right? But it ends, but it's a term, so it ends soon. Reduced paid up till age, it reaches to age 100, but it's less coverage.
Instead of
It's,
300, it'll go down
it'll
to
go
like
down
30.
to 30,000 or 100,000. How much it goes down, they don't test you on that. They just want you to know the mechanics. Extended term keeps the same. It's the highest coverage, non-forfeiture option, but it ends soon. Reduced paid up, it reduces the coverage, but it lasts till age 100. Got it? So just remember the word term, it ends soon, and it has the same coverage. Reduced paid up, it's paid up. Paid up means till age 100. That's what paid up
Yeah.
means, right? But it reduces what? It reduces the coverage. So it's in the word. Just think of that, okay? So it doesn't matter how they throw it at you, you're gonna get it right because, let's see, cash accumulation. So this is dividend options. So dividend options. What policies pay dividends? What are they called? What policies? By the way, are dividends guaranteed? No. Good job. What kind of policies pay dividends? What kind of policies pay dividends? It's
It's a word.
yep, yep, yep.
Say, say like mutual.
There you go. You're close. There you go. So mutual companies pay dividends. And also they're also called participating participating policies. So mutual companies and participating policies pay dividends. Okay? Good job. All right. And dividends are not guaranteed. What is a dividend? What is a dividend? It's a return of what? It's a return of excess premiums. So basically the insurance company, the mutual company is overcharging the client and whatever they're overcharging, they want to give it back to them in form of a dividend, but they're not guaranteed. Crazy, huh? So they're gonna overcharge you, and it's not guaranteed that you're gonna get it back. It's a ripoff, but in the test they don't ask you, is this a ripoff? They don't ask you that. Okay, it's a ripoff, but in the test they don't ask you that. Okay, so when they do give you dividends, then you get divid. That's where dividend options comes into play. Dividend options. When they do give you dividends, what are your options? Your options are cash. Just give me my money. Reduction of premiums. Just lower down my premiums. Easy, right? Accumulation at interest. Just put it in an account and let it gain interest.
Mm,
Paid up additions. Use my dividends to give me more coverage till age. What's paid up mean? Till age 100. And then number five is use my dividends, but give me 1 year term insurance. So give me whatever that dividend pays for a 1 year term policy. So I want coverage for a year with those dividends. Okay. It's all in the word. Okay. So just use your common sense, use your gut. Okay. But again, dividend options, mutual companies, participating policies, they're not guaranteed. It's an overpayment of premium, and you could do this with them. Okay. Any questions? This is a big chapter. This is a really important chapter. All this stuff is going to be on the test right here. All right. Settlement options. What's the scenario here? The scenario is that the insurance company asks you, how do you want your money? That's called the settlement options. Okay, so let's say you're the insurance companies and you're selling me a policy and you say, okay, Raul, you're covered for 500,000, your beneficiary is your wife. So if you die, how do you want your wife to get that money? That's called a settlement option.
The other one was
Dividend option,
dividend.
which is which is right. And then the previous one was non-forfeiture option. What's the scenario for a non-forfeiture option? What's the scenario? I don't want to forfeit, remember?
Mhm. No,
Your policy. You don't want to
you
forfeit
want to
your
forward your
policy.
policy.
But what's the scenario? The person, what? What's his circumstance? The client, what's his circumstance? They can't afford to pay the premiums. That's it. Okay. But settlement options is what's the scenario? How they're gonna get their money. Good, good. This is good. All right, cool. All right, so cash. You could get your money cash. You could get your money life income. This is monthly payments for life. Okay. Income. That means monthly payments, income for life till they die. Everything's in the word. Just use your common sense, okay? Another one. So it's single life means for one person. So do you want life income for one person? Then it's called single life. Okay? Or for two or more. It's called joint or joint and survivor. Okay, so what do you remember about joint and survivor, bro?
One survivor is it covers both,
Mm-hmm.
but only when both of them.
There you go. So this is they call it last to die. In other words, when they both die. Same thing. Joint life. Joint life is what? It covers two or more people, but when does it pay? No, that's survivor.
That's oh wait, that's
Um,
survivor.
yeah.
Joint life is um when both of them dies. Oh, joint life is when it covers both of them, but it only no.
Yep, it
It
covers
covers
both of
both of
them,
them, but
but
only the person that dies first
it's
pays
whoever
the
dies
most.
first. It pays. Exactly right. Yep, yep, yep. Another settlement option, life refund. Life refund. Life refund income option comes either in cash refund or installments refund form. So it's either just cash out too or cash out in monthly payments. All right. Life with period certain. It pays income, but it guarantees income for sure for a certain period of time, like 20 years, for example. Okay. Because this I don't want to confuse you, but single life, it pays income for life. But what if they only live 1 year? If they live 1 year, they're still there's that the policy, the income stops. And what happens to all the extra money? Because there's still money left over after 1 year. It goes back to the insurance company. Yeah. So it's kind of like sucks, but people like it because what if because they're not thinking I'm gonna die in a year. They're thinking, what if I live 100 years? Then I'm gonna make a lot of money. See what I mean? But life period certain, it what if you die? It's for people that are afraid of dying in a year. So they want guaranteed a certain period of time. Period certain. Interest only. So that one is like, look, Larry, if I die, just put my money in an account and give my wife interest from that money.
That's what I was thinking about.
Yeah. Fixed period installments. Fixed period means, Larry, if I die, I want my wife to get income for this period of time. Fixed period. 30 years. Okay. Fixed period. Fixed amount is, Larry, if I die, I want my wife to receive payments to receive 8,000 a month for sure. And the income and the payment amount stops when the money runs out. Make sense? All right, let's go to the next one. Oh, that's it. Wow. We gotta go though. Dang, dude. All right, that was good. We killed chapter 4. So let's go, man. Let's make this happen.
Right?
It's time, bro. It's your time. It's Larry. It's Larry's time. I'm gonna pass Larry. All right. Let's go. Let's see what room is available. If not, we'll just you just have to do it here. Let's go. You have your ID?
Yes. I would like it. Do I have it?
You got this.
Thank you.